Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight. And if you thought last quarter was wild, buckle up, because RTX Corporation just dropped their June 30th quarterly report, and it sounds like things might be getting even more interesting. With over $1 billion in share buybacks authorized and a host of new legal and regulatory updates, this report is a big one. First off, let's look at the top line. RTX pulled in a cool $21.6 billion in sales during the second quarter ending June 30th. That's a solid jump up from $19.7 billion last year. And for the first 6 months of the year, they've raked in an impressive $41.9 billion. The company is clearly selling a lot of products and services. Looking at the breakdown, product sales are bringing in the bulk of the cash, nearly $15.6 billion this quarter, up from $14.6 billion last year. Services are also growing, hitting $6 billion this quarter, up from $5.2 billion. This shows a healthy balance between selling new stuff and maintaining and supporting what's already out there. Now for the real money maker, net income. For the second quarter, RTX managed to make a profit of $1.66 billion attributable to common shareholders, a massive leap from just $111 million last year, and for the first half of the year, they've already earned over $3.1 billion. That's a huge turnaround from last year's first half, which only brought in $1.8 billion. This is the kind of number that gets investors excited. Even more impressive, their diluted earnings per share jumped from a mere 8 cents last year to $1.22 this quarter. That's making shareholders a lot of money. Digging into profitability, their operating profit for the quarter landed at a strong $2.1 billion, a big jump from last year's $529 million. And for the first 6 months, operating profit is up to $4.2 billion from $2.4 billion last year. This boost looks like it's coming from across the board. Collins Aerospace is seeing its operating profit climb nicely, and Pratt & Whitney, while down slightly in the quarter, is still a money-making machine overall for the 6-month period. Raytheon also had a stellar performance, especially looking at the operating profit surge this quarter to $805 million from just $120, while down slightly in the quarter, is still a money-making machine overall for the 6-month period. Raytheon also had a stellar performance, especially looking at the operating profit surge this quarter to $800 across the board. Collins Aerospace is seeing its operating profit climb nicely, and Pratt & Whitney, while down slightly in the quarter, is still a money-making machine overall for the 6-month period. Raytheon also had a stellar performance, especially looking at the operating profit surge this quarter to $800. Their Collins Aerospace segment is chugging along. Net sales are up 9% for the quarter and 9% for the first half of the year. They're pulling in $7.6 billion in sales this quarter, and profits are up 5% for the quarter and a healthy 15% for the first half. Pratt & Whitney is also showing strong growth. Their net sales are up 12% this quarter and 13% for the first half, bringing in $7.6 billion in quarterly sales. While their operating profit saw a slight dip in the quarter, it's still up 12% for the first 6 months. And then there's Raytheon. After a rough start last year, they're bouncing back with gusto. Net sales are up 8% this quarter and 1% for the first half, bringing in $7 billion in quarterly sales. But the real story here is operating 4% this quarter and 32% for the first half. This segment seems to have found its stride. Backlog for Raytheon's defense business is also looking solid at $64 billion. Now let's talk about the balance sheet. They have 12 times $4 billion in accounts receivable, meaning customers owe them a good chunk of change, which is normal for a company this size. Their inventory is also up to $14 billion, suggesting they're producing a lot to meet demand. On the debt front, RTX has about $42 billion in total debt as of June. That sounds like a lot, but when you look at their total capitalization, which is around $106 billion, their debt to capitalization ratio is about 40%. This is a pretty standard and manageable level, giving them financial breathing room. They also have a $5 billion credit line they aren't even using, which is always a good sign of financial health. Interestingly, they've increased their commercial paper borrowing significantly to $1.4 billion from zero last year, suggesting they might be using this short-term debt for various corporate purposes like funding acquisitions or dividends. Now for the more complex stuff, RTX disclosed nearly $11.5 billion in industrial cooperation agreements, mostly dealing with offset obligations in foreign countries. It's a way they try to bring economic value to those places. They're also facing some pretty hefty government investigations, including deferred prosecution agreements with the Justice Department and settlements with the SEC. These came from issues related to past payments in the Middle East and contract pricing disputes. They've paid substantial fines, but overall they seem to be managing these legal entanglements. They also had an issue with powder metal in some of their Pratt & Whitney engines, leading to elevated aircraft on ground levels and an expected charge of over $1 billion for customer compensation and maintenance costs. A big part of RTX's business is with the US government, making up about 38% of their sales this quarter. Foreign military sales are also significant, adding another 7 to 8%. This reliance on government contracts means their performance can be heavily influenced by defense spending and policy changes. The company acknowledges many risks, from economic downturns and supply chain disruptions to geopolitical tensions and regulatory changes. They're also dealing with the ongoing effects of inflation, which is pushing up costs for materials and labor. They've tried to mitigate these by improving operations and digital transformation, but it's a tough environment. So what's my take on all this? RTX is clearly navigating a strong recovery, especially in their defense segment, with Raytheon leading the charge. The huge jump in profits and earnings per share this quarter is undeniable, showing they can really move the needle when things go right. However, costs are still a major concern, especially with inflation and the ongoing supply chain issues. The powder metal engine problem at Pratt & Whitney also looms large, and while they've booked charges, the actual long-term impact is still a bit of a question mark. Their strategy seems focused on integrating acquisitions and managing these ongoing challenges. While the revenue growth is impressive, the lingering legal and regulatory issues, though seemingly managed, still present a background risk. It's a company that's getting its house in order and showing strong operational improvements, with Raytheon's turnaround being a particular highlight, but they're not out of the woods yet concerning those legacy issues and cost pressures. Alright, that's our breakdown of RTX's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.